Welcome back. In today's video, I'm going to be covering a small cap company by the name of Danaos. This company provides ships for supply chain companies to move containers around the world. They've been doing really well for 5 years, and I'd like to take a look at their financials and see if it's a good company to invest in. I don't currently own any shares in this company. This company actually came up in one of the comments on one of the videos that I produced, and for the subscriber that provided that tip, thanks for the idea. And here I am. I analyzed the company and I'm recording a video. So I'm going to get into my process that I use as I evaluate companies. And this is a very fresh company. I looked at their financials. I'll go over their financials and then get to a conclusion, which is, am I going to buy shares or am I going to not buy shares in this company? Before I move into the analysis, do me a favor and like the video, subscribe to the channel, and keep those comments coming. I really appreciate the comments on the companies that I cover, and as well as the videos themselves. I try to improve videos based on comments. So let's get into this company. So I follow a consistent process that I've developed for myself over the years. And the process involves 4 key questions followed by a decision to buy or not buy this particular company. And first, I want to make a decision. Do I want to be a part owner in this company? Do I want to be part of the industry? Do I think their management team's doing a good job and operating the business well? Is debt under control, well below 3 times EBITDA? And I want to discount the stock so that way I can make money on my investment in this particular company. And based on the answers to those questions, I buy, hold, or sell. So we live in a connected world that has a global supply chain. Here in the United States, we get so many goods from Asia, from Europe, from all over the world, and they're carried around on these big ships. And these ships carry containers worth of stuff, both into the United States as well as from the United States to other parts of the world. And other Asia ships to Europe, Europe ships to Africa, so these ships are all over the world, getting goods from where they're produced over to where they're going to be consumed. Needless to say, supply chains are really important and I think are going to continue to be in high demand. Therefore, I'm really interested in a company like this that actually owns the ships and leases them out to the companies that operate them to move goods around the world. I think it's a solid business. They're going to have demand for a long time. So I like the industry. And this company in particular, I really like because they've been growing their business. And I think it's a good mindset for them to have, which is to have a very large fleet of ships that they lease out to the leading companies that operate them. Looking at their annual report for 2022, it shows that their revenue, they've done a really nice job of pretty much doubling the company. They have $458 million in revenue, but now they're close to $1 billion in revenue if they add up all the revenues for 2022. So great job in growing the business. Also, profitability has been really good for the last 4 years. Diving into the income statement for the most recently closed quarter, we can take a look at revenues, which are coming down a little bit. The last quarter that ended on June 30th was $241 million, but the prior year was close to $251 million. So it's gone down about $10 million in revenue on the top line. That's understandable. I know that inventories here in the United States, retailers and other merchants actually have excess inventory. So there's not a lot of demand for new replenished inventory, but I think that'll eventually, pick up. For now, I can understand that they had, less volumes being shipped. So understandable that the revenue did dip a little bit. What's good to know is that they are continue to be profitable, which is very good. And for the first 6 months, which is represented in this column, they are, really carrying a nice profit for the first 6 months. And I think that's going to continue through the rest of 2023. Looking at the balance sheet for this company, they've got a fair amount of cash on the balance sheet, $293 million, especially compared to the balance sheet long-term debt, which is 390 plus 27. So $417 million of debt. The net debt, when you take the debt minus the cash, is really only $124 million. Their EBITDA for a full year is approximately 374. So it's well below that 3 ratio that I'm looking for. What this means is they can basically pay for all their debt if they operated the business for about 4 months and just strictly paid off debt. So debt is under control. They have a healthy balance sheet. Looking at the statement of cash flows, it is doing well. If we look at the first 6 months, they've produced $280 million from operations. They've only had to put about 30 million back into the business to keep things operating. So overall, they have about $250 million of free cash flow. I also looked at the last 5 years, took an average, and happened to coincide with that number. It ended up being $252 million of free cash flow on average. So I'm going to use that number in my valuation using free cash flows. I believe that Danaos is discounted by 63%. What I mean by that is that each share, I think, is worth about $107 per share, but the stock market will sell you shares at $66. I get to this value by looking at free cash flows and earnings per share. The free cash flows, I estimate the average for the last 5 years is $252 million. So I'm going to use that as a starting point. I actually think it's going to go down over the next couple of years just to be super conservative and expect that we're going to have this recession prolong. The amount of shipping isn't going to be as high as prior years. So just to be conservative, I'm going to have it go down for the first 4 years. After that, I'm going to have it grow at 3%, as I expect after year 4. There will be some growth, and all the cash flows after year 4 will be about $2.3 billion in free cash flows. I'm going to discount those free cash flows to get to a net present value of today's value of those cash flows by 12%, which is a nice high discount rate, making this a conservative estimate. And I get a value of $2 billion for all those cash flows. I'm going to add the cash on the balance sheet and take away the debt, which brings us to an equity value of $1,887 million of value in this company. Their current market cap is 1.3 billion. So it offers up a 42% upside using the free cash flow method. Looking at earnings per share, their earnings per share look really good. Looking at the next 4 quarters that I expect, they're going to produce about $30 per share, which is really attractive. And if I discount those that earnings per share and I value the company based on that using the earnings per share valuation method calculation here, I get to a stock price of $135.99. But you can buy shares for $66 from the stock market. So there's really a really attractive discount when you use the earnings per share method. I use the free cash flow method as most of the valuation. I use 2 parts free cash flow method, 1 part earnings per share. And I get to an average of 63% as the potential upside on this stock in Danaos. Looking at the stock over the last couple of years, it really had a nice run up at the beginning of 2021. It really went up, and obviously their strategy really works. So the company got valued much higher. It's been hovering around between $50 and $70 per share, and their current stock price is at $66 per share. I think the company is worth 107, so it provides a nice upside potential in this stock. Year to date, they're up 23.7, so you'd be beating the S&P if you had bought shares in Danaos on January 1st. And they pay a dividend of 4.5%, so it's a nice, healthy dividend on a company that has fairly good profitability. So should I buy shares in Danaos? Well, let me go over my 4 questions that lead to that decision. I do want to be a part owner in this business. I really believe that the supply chains that we have are just going to continue to get bigger, and they're going to be more important in the future. The whole global economy, it isn't going away. I think we're just going to continue to have goods being shipped around the world, and these ships are going to be really important for all the producers to get their products to the markets that consume them. I like the company. They're operated very well. Their strategy has really worked. So their management team has great vision and has really led the company well. Debt is well under control, way below 3 times EBITDA. And they offer up a nice discount, and they'll pay a dividend too. Therefore, I'm going to begin to buy stocks in Danaos. That's my video on Danaos. Again, I want to thank that subscriber that uh, gave me the tip on a comment that I should look at DAC. It was a nice tip. I looked at it, and it's a really good company, so I appreciate that. Please comment on this video and provide feedback on the company, what you think of the company, what you think of the video, and any other ideas that you have in this industry. Do me a favor and like the video and subscribe to my channel. I'd really appreciate that. Good luck investing in 2023.